October 1929. The streets of New York City are in chaos. You have likely seen the pictures. Men in expensive suits standing on street corners, selling apples for a nickel. Lines of desperate people wrapping around city blocks, not waiting for a movie premiere, but waiting to withdraw their life savings from banks that have already locked their doors. We have been told a simple story about this moment. We have been taught that the stock market crashed, greed was punished, and the economy naturally collapsed. But that story is a lie. The stock market crash of 1929 was a tragedy, yes. It wiped out fortunes, it shattered confidence. But a stock market crash does not destroy a nation's soul. It does not force 25% of the population into unemployment. It does not cause people in the richest country on earth to starve to death. A market crash is a spark. But for a spark to burn down the entire house, someone has to pour gasoline on the fire. For decades, the true culprit of the Great Depression hid in plain sight. It wasn't the speculators, it wasn't the consumers, it wasn't even the president. The fingerprint on the murder weapon belongs to the very institution created to save us. This is the story of how a small group of men in a boardroom in Washington, D.C., armed with good intentions and bad theories, accidentally committed the greatest economic homicide in history. This is the story of the Federal Reserve's Suicide Pact of 1929.
To understand the funeral, we first have to understand the party, and what a party it was. The 1920s in America wasn't just a decade, it was an explosion. They called it the Roaring Twenties for a reason. Emerging from the ashes of World War I, the United States had transformed into an industrial juggernaut. Electricity was lighting up homes for the first time. Henry Ford's assembly lines were pumping out Model Ts that ordinary people could actually afford. The radio brought jazz and news into living rooms from coast to coast. Optimism wasn't just a feeling, it was the currency of the realm. And for the first time in history, ordinary Americans discovered the magic of credit. Buy now, pay later became the national anthem. You didn't need to save up for a washing machine, you just needed a down payment. And nowhere was this easy money more addictive than on Wall Street. The stock market became a national obsession. It wasn't just for the tycoons like Rockefeller or Morgan anymore. The grocer, the taxi driver, the shoe shiner, everyone was buying stocks, and they were buying on margin. This meant you could buy $100 worth of stock with only $10 in your pocket. The other $90 was borrowed from the broker. It was free money. As long as the market went up, everyone was a genius, and the market always went up. From 1921 to 1929, the Dow Jones Industrial Average increased six-fold. Economists proclaimed that we had reached a permanently high plateau. The Federal Reserve, the central bank of the United States, watched this frenzy with growing unease. They were the chaperones at this drunken party. Their job was to take away the punch bowl just as the party was getting good. But in the late 1920s, the Federal Reserve was a house divided. The most powerful man in the system was Benjamin Strong, the head of the New York Fed. He was a brilliant, decisive leader who understood the delicate dance of the global economy. He knew that if he raised interest rates too high to stop the speculation on Wall Street, he might crush the struggling economies of Europe, particularly Great Britain. He was the glue holding the international system together. But in October 1928, tragedy struck. Benjamin Strong died. His death left a power vacuum at the worst possible moment. Control of the Federal Reserve shifted from the experienced hands in New York to the Federal Reserve Board in Washington, D.C., a group of men who had far less experience and far more rigid ideologies. They looked at the stock market bubble not as a sign of prosperity, but as a symbol of moral decay. They believed that speculation was a sin that had to be purged. They wanted to pop the bubble. They had no idea that in trying to pop the bubble, they were about to stop the heart of the American economy.
Tuesday, October 29th, 1929. Black Tuesday. The bubble finally burst. The panic was instantaneous and absolute. Ticker tape machines couldn't keep up with the sell orders. On the floor of the New York Stock Exchange, grown men wept openly. In a single day, billions of dollars in wealth simply evaporated. The stories of brokers jumping out of windows became urban legends, but the financial devastation was very real. Those who had bought on margin were wiped out instantly. They didn't just lose their investments, they owed money they didn't have. They lost their homes, their cars, their savings. However, contrary to popular belief, the crash of 1929 did not immediately cause the Great Depression. In fact, by early 1930, the stock market had actually recovered a significant portion of its losses. Unemployment was up, yes, but it wasn't catastrophic yet. It looked like a typical recession, a painful correction, but a manageable one. The economy had been through panics before, in 1907, in 1921, and it had always bounced back. The system was supposed to work like this. When the economy slows down, the central bank should step in. They should act as a lender of last resort, providing cash to solvent banks to prevent panic and lowering interest rates to encourage businesses to hire and build again. That is the playbook. That is why the Federal Reserve was created in 1913, to prevent banking panics. But in 1930, the Federal Reserve did not follow the playbook. They threw it into the fire. As the economy began to weaken, a wave of fear swept through the public. People began to worry about the safety of their money. In those days, deposits weren't insured. If a bank went bust, your money was gone forever. So when rumors started that a bank was in trouble, people rushed to withdraw their cash. This is called a bank run. A bank run is a self-fulfilling prophecy. Banks don't keep all your money in the vault. They lend it out to build houses and factories. If everyone asks for their money back at the same time, even a healthy bank will collapse. This is exactly where the Fed was supposed to step in. They were supposed to print money and lend it to the banks until the panic subsided. But they didn't.
Why? Why did the Federal Reserve stand by and watch the banking system disintegrate? The answer lies in a dangerous economic theory known as liquidationism. This view was championed by Andrew Mellon, the Secretary of the Treasury, and shared by many on the Federal Reserve Board. They believed that the economy needed to be purged. They viewed the recession not as a disaster to be fought, but as a necessary medicine to cure the excesses of the Roaring Twenties. Andrew Mellon famously advised President Herbert Hoover, liquidate labor, liquidate stocks, liquidate farmers, liquidate real estate. It will purge the rottenness out of the system. They believed by letting weak banks fail and letting wages fall, the economy would naturally reset itself on a stronger foundation. They saw the collapse of the money supply not as a danger, but as a natural correction. So, when the first wave of bank failures hit in late 1930, starting with the Bank of United States in New York, the Fed did nothing. The Bank of United States wasn't just any bank, it was a massive commercial bank with over 400,000 depositors, mostly immigrants. When it collapsed, it sent a shockwave of terror across the country. If a bank that big could fail, nobody was safe. People pulled their money out of banks and stuffed it under their mattresses. This action had a catastrophic effect on the money supply. In economics, money isn't just the cash in your pocket, it's the credit flowing through the system. When you deposit $1, the bank lends out 90 cents. That loan becomes someone else's deposit, which gets lent out again. This multiplier effect creates liquidity. But when people hoard cash, that multiplier stops. The money supply contracts. Between 1929 and 1933, the Federal Reserve allowed the money supply in the United States to fall by 1/3. Think about that. 1 out of every $3 in circulation effectively vanished. Imagine you are running a business. You have debts to pay, wages to meet, materials to buy. Suddenly, there is 1/3 less money in the entire economy. Customers stop buying. You can't get a loan. You have to lower prices just to sell anything. This leads to deflation. Deflation is the true monster of the Great Depression. We often fear inflation, but deflation is far harder to kill. When prices fall, businesses make less profit. They cut wages and fire workers. Those workers then spend less, forcing prices down even further. It is a death spiral. And the only entity that could have stopped it by pumping money into the system was the Federal Reserve. But they were worried about the wrong things. They were worried that if they printed money to save the banks, they would ignite speculation again. They were worried about protecting the gold reserves. They were fighting the last war, oblivious to the fact that the ground was opening up beneath their feet.
The Fed's mistake didn't just destroy the American economy, it exported the depression to the rest of the world. The transmission mechanism was the gold standard. In 1929, major world currencies were pegged to gold. This meant that if the U.S. economy contracted and interest rates stayed relatively high to protect the gold stock, other countries were forced to follow suit. They had to raise their own interest rates and contract their own economies to keep their currencies aligned with the dollar and gold. Instead of expanding their economies to fight the downturn, countries like Britain, France, and Germany were forced to tighten their belts. The gold standard became, as historians later called it, golden fetters, chains that dragged the entire global economy down into the abyss together. By 1931, the panic had gone global. European banks were collapsing. And in a final act of incompetence, in late 1931, after Britain abandoned the gold standard, the Federal Reserve actually raised interest rates. They raised rates in the middle of a depression. They did it to stop gold from flowing out of the country, prioritizing the rules of the gold standard over the survival of the American people. It was the final nail in the coffin. The banking system crumbled. By 1933, thousands of banks had failed. The savings of millions of families were gone. The unemployment rate hit 25%. Industrial production had fallen by half. The American dream had become a nightmare.
It is easy to get lost in the numbers. GDP, money supply, deflation. But the Great Depression was not a chart, it was a human tragedy. It was fathers leaving their homes in the middle of the night because they couldn't bear to look their hungry children in the eye. It was Hoovervilles, shanty towns built of scrap metal and cardboard, springing up in Central Park. It was farmers in the Dust Bowl watching their land blow away, while banks foreclosed on properties that had been in families for generations. The psychological toll was immeasurable. A generation of Americans learned to hoard, to fear debt, and to never fully trust the banking system again. The belief that tomorrow will be better than today was shattered. And it didn't have to happen. We know this because of what happened next. When Franklin D. Roosevelt took office in 1933, one of his first acts was to declare a bank holiday, closing all banks to stop the panic. But more importantly, the U.S. eventually broke the link with gold and began to expand the money supply. Deposit insurance was created. The bleeding stopped. The recovery was slow and painful, but the freefall ended once the monetary contraction was reversed.
For decades, history books taught us that capitalism failed in 1929. They taught us that the market was inherently unstable and required massive government intervention to manage. While regulations are important, the modern economic consensus, led by scholars like Milton Friedman and Anna Schwartz, points the finger squarely at the government agency itself. The Great Depression was not a failure of the free market alone. It was a failure of government policy. It was a failure of the Federal Reserve to do the one job it was designed to do. In 2002, at a conference honoring Milton Friedman on his 90th birthday, Bernanke, who was then a governor on the Federal Reserve Board and would later become its chairman during the 2008 crisis, stood up and said something remarkable. He said to Friedman, "Regarding the Great Depression, you're right, we did it. We're very sorry, but thanks to you, we won't do it again." That admission is chilling. It confirms that the suffering of the 1930s, the hunger, the poverty, the rise of political extremism that led to World War II was not inevitable. It was the result of human error. It was the result of smart people in a closed room holding on to bad ideas when the world was burning. Today, as we navigate our own economic uncertainties, with central banks around the world once again raising rates to fight inflation, we must look back at 1929 not just as history, but as a warning. The machinery of the economy is fragile, and the hands at the controls are only human. We often ask what caused the Great Depression. The answer isn't just a stock market crash. The answer is that we committed economic suicide, and we simply forgot to unlock the safety on the gun.